Stop. Before you put another dollar into stocks, before you move another dollar into bonds, before you buy more crypto, I need you to watch this video because I have been doing something obsessive for the last several months. I went back and pulled the hard data on 5 assets that are all marketed to you as safe havens: gold, silver, US Treasury Bonds, the US dollar, and Bitcoin. And I ran every single one of them through 5 of the worst financial crises of the last 20 years. Not what the financial media told you happened. The actual numbers, the actual price performance, the actual behavior of these assets at the exact moments when you needed them the most. And what I found should make every retail investor in America furious. Because one of these so-called safe havens failed in its first major real-world test so badly that it dropped almost half its value in a single day. One of them got secretly sold off by the very banks that were supposed to be holding it for you during the 2008 meltdown. And one of them, the one the mainstream media has been telling you, is old-fashioned and irrelevant, quietly outperformed in 4 out of 5 crises, and it is right now sitting at prices we have never seen in human history. We are going to judge each asset across the same 5 categories: price behavior at crisis onset, liquidity and actual access to your money, counterparty risk, inflation hedge performance over the full crisis window, and Arthur's verdict. Same 5 categories, every crisis. Scoreboard at the end. I'm Arthur, and this is Smart Money History. Here are our 5 safe haven assets and what Wall Street tells you about each of them. First, gold, the oldest store of value in human history, now trading above $5,000 per ounce. Second, silver, the industrial monetary metal that is deeply tied to both financial panic buying and real-world manufacturing demand. Third, US Treasury Bonds, the bedrock of the so-called risk-free rate, the thing every pension fund manager and 401k planner tells you is the safest place to park your money. Fourth, the US dollar itself, the world's reserve currency, the anchor of global trade, the thing you are automatically holding if you're sitting in cash. Fifth, Bitcoin, the new kid, the digital gold narrative, the asset that crypto advocates say will replace everything else on this list. 5 assets, 5 crises. Let's go. Crisis 1, the 2008 financial collapse. The setup. September 15, 2008, Lehman Brothers, one of the oldest investment banks on the planet, over 150 years old, files for bankruptcy. It is the largest bankruptcy in American history. The Dow Jones drops 900 points in a single day. The S&P 500 eventually falls nearly 57% peak to trough. Over 10 million Americans have lost their jobs. Regular people are watching their retirement accounts get cut in half. This is the stress test. This is the moment every safe haven is supposed to earn its title. Gold. Here is where it gets complicated, and where I need you to pay very close attention, because Wall Street uses this data selectively to manipulate your thinking. In the immediate panic of late 2008, gold actually dropped from over $1,000 an ounce down to about $730. Why? Because the banks that were drowning in liquidity problems quietly borrowed gold from central bank reserves and sold it into the market to raise emergency cash. This is documented. They needed dollars, and gold was one of the few things they could sell fast. But then something important happened. Once the acute panic passed and the Fed started printing money, gold did what it was designed to do. From its 2008 low all the way through 2011, gold ran from roughly $700 to over $1,900 per ounce. That is a gain of over 160% in under 3 years. Someone who held physical gold through the full crisis window did not just survive. They more than doubled their money while the stock market was still licking its wounds. Full crisis window performance, strongly positive. Initial panic, volatile. Lesson: physical gold rewards patience. Silver's story in 2008 is even more dramatic. It crashed harder than gold in the panic, falling from around $20 an ounce all the way to $9. That is a 55% drop. Brutal. But the recovery was even more explosive. By April 2011, silver had clawed its way to just under $50 an ounce. That is a climb of 448% from its crisis low in roughly 2.5 years. Silver is not a safe haven in a moment of panic. It is the safe haven of what comes after. The money printing, the debasement, the realization that the system was kept alive by flooding the world with new dollars. Treasury bonds. This is where financial media loves to point. 10-year Treasury bonds gained about 17% during the 2008 crisis window. The flight to safety was real. Every scared institution in the world piled into treasuries, which pushed their prices up. And if you sold at exactly the right time, you captured that gain. But most retail investors do not sell at exactly the right time, and the yields you locked in at the bottom of that rate cycle were microscopic. You were being paid almost nothing to hold the so-called safest asset in the world, US dollar. The dollar actually strengthened during the acute phase of 2008. When global markets panic, they flood into the dollar because it is still the world's reserve currency. Cash looked smart in September 2008, But then the Fed launched the first round of quantitative easing, essentially creating trillions of new dollars out of nothing, and the dollar began losing purchasing power. If you stayed in cash thinking you were safe, inflation was already beginning its quiet assault on your savings. Bitcoin did not exist in its current form during the 2008 crisis. It was created in response to the crisis. Satoshi Nakamoto published the original Bitcoin white paper on October 31, 2008, roughly 6 weeks after Lehman collapsed. So Bitcoin gets an incomplete grade here, but that origin story matters because it tells you exactly what Bitcoin was designed to solve. Crisis 1 scorecard gold edges out a win on the full window basis. Silver, volatile but spectacular in the recovery. Treasuries, short-term shelter, long-term trap. Dollar, strong initially, then slowly eroded by QE. Bitcoin, not in play. Crisis 2, the 2011 Eurozone debt crisis, the setup. Greece, Ireland, Portugal, Spain, Italy. 5 countries on the edge of sovereign default. The euro looked like it might actually break apart. The Swiss National Bank took the extraordinary step of promising to print Swiss francs in unlimited quantities to hold its currency peg. If you were an American investor watching this, it felt like the entire system of Western debt was unraveling. Gold loved this environment. It climbed 31% during the second wave of the European sovereign debt crisis alone, reaching its then all-time high of $1,917.90 per ounce in late August 2011. Think about that number, $1,900. That was the peak that nobody challenged for over a decade, and it happened precisely because the world's governments were demonstrating in real time that sovereign debt is not safe, that countries can and do run out of money, that the whole edifice of government bonds as the ultimate safe haven was a story, not a fact. Silver made its most famous move here. From roughly $18 per ounce in late 2010, silver ran to just under $50 in April 2011, a 165% gain in under 8 months. It was silver's first real moment in the spotlight for a new generation of investors. Then the CME, the Chicago Mercantile Exchange, raised silver margin requirements 5 separate times in just 9 days. 5 times. In 9 days, silver fell 30% in a matter of weeks. Demand for physical silver did not disappear, but the leveraged paper market got wiped out, and the price followed. This is one of the most important lessons in this entire video. The paper silver price is not the same as the physical silver market. When institutions want to suppress the price, they can do it through the derivatives market in ways that have nothing to do with actual supply and demand. Treasury bonds treasuries gained about 7% in the first wave and continued performing during the second wave as investors ran from European debt to American debt. For this particular crisis, treasuries looked relatively safe because the crisis was specifically about European sovereign bonds, not American ones. The comparison held for a moment. US dollar. The dollar strengthened as the euro weakened. Holding dollars in 2011 felt smart if you were watching the European news cycle. But again, the Fed was still running an accommodative policy, real interest rates were negative, and the dollar's purchasing power was being quietly eroded. Bitcoin existed but was still largely unknown to mainstream investors. It traded for under $10 for most of 2011. It was too early for any meaningful crisis analysis. Crisis 2, scorecard gold, dominant, silver, spectacular gains, then artificially crushed, revealing the paper market's dark side. Treasuries, temporarily favorable. Dollar, short-term beneficiary of European chaos. Bitcoin, still embryonic. Crisis 3, the March 2020 COVID crash, the setup. March 12, 2020. The World Health Organization declares a global pandemic. The Dow Jones fell nearly 3,000 points in a single session, the largest single-day point drop in its history at that time. Circuit breakers on the S&P 500 were triggered 4 times in the month of March alone. The entire global economy is locked down. Every asset class was selling simultaneously. This is the crisis where everything changed, and I need you to brace yourself for what the data actually shows, because it contradicts almost everything you've been told. Gold. On March 12, 2020, the day the S&P 500 dropped nearly 10%, gold lost 4.9% of its value. The next day, more losses. In the acute panic of March 2020, gold moved in tandem with stock market losses 7 out of 10 times. Gold failed as a short-term safe haven in the COVID crash. There, I said it, and the data backs it up. But here is the rest of the story that the mainstream will not tell you. Once the Federal Reserve announced unlimited quantitative easing, unlimited gold reversed hard. By August 2020, gold had reached a then-record high of $2,070 per ounce. Anyone who held through the panic made substantial gains. The short-term failure was followed by a long-term vindication. Silver was worse. It crashed to $12 per ounce in March 2020. That's a 59% drop from its late 2019 levels. By any measure, silver failed the acute panic test completely, but again, the recovery was extraordinary. By August 2020, silver had rocketed to $29 per ounce, over 100% in roughly 5 months. The lesson from silver in 2020 is that the panic sell-off created a loading zone, not a reason to abandon the metal. Treasury bonds. For the first 2 weeks of March 2020, Treasuries did their job. Prices rose as investors fled to safety. But then something deeply unusual happened. U.S. Treasury markets began to seize up. Liquidity in the world's supposedly most liquid market dried up. The Fed had to intervene directly, buying treasuries in emergency operations to prevent a complete breakdown. The bedrock of the global financial system briefly became dysfunctional, and most retail investors have no idea this happened. Bitcoin now, here is the moment Bitcoin enthusiasts do not want to talk about. On March 13, 2020, as the S&P 500 fell 10%, Bitcoin dropped 46.5% in a single day. It fell from around $9,000 to under $4,000. That is not a hedge. That is a leveraged risk asset moving in lockstep with speculative tech stocks. Bitcoin failed its first real-world safe haven test catastrophically. This is not an opinion. This is the documented data from that specific day. Now, Bitcoin then went on to an extraordinary recovery, eventually reaching $69,000 by late 2021. But in the moment of maximum fear, when you needed a safe haven most, Bitcoin collapsed harder than almost everything else. U.S. dollar. The dollar temporarily surged in the March panic as global institutions scrambled for dollar liquidity. But by the end of 2020, the dollar index was down over 6% for the year because the Fed printed more money in 2020 than in any previous year in American history. Over 40% of all U.S. dollars in existence at that time were created in roughly a 12-month window. Crisis 3 scorecard. Gold, short-term fail, long-term vindication. Silver, same pattern, more extreme in both directions. Treasuries, nearly broke. Bitcoin, catastrophic failure at the critical moment. Dollar, panic beneficiary, then steadily eroded by the largest monetary expansion in modern American history. Crisis 4. The 2022 stagflation shock, the setup. 2022 delivered something the modern financial system had not seen in 40 years. Inflation above 8% in the United States, combined with an aggressive Federal Reserve rate hiking campaign, combined with a major European war. Russia invaded Ukraine on February 24, 2022. Energy prices spiked, food prices spiked, and the Fed began raising rates faster than at any point since Paul Volcker was trying to break inflation in the 1980s. This is the crisis where the so-called safe havens were not being tested against panic. They were being tested against sustained, grinding purchasing power destruction, a different kind of threat. Gold initially surged when Russia invaded Ukraine, briefly touching $2,051 per ounce in March 2022, its highest level since the 2020 peak. Safe haven buying was real and immediate. But then the Fed began hiking rates aggressively. Higher real interest rates traditionally pressure gold because gold pays no yield, and suddenly you could get a meaningful yield on cash or short-term treasuries. Gold pulled back, falling below $1,650 by October 2022. For full year 2022, the only major asset class that had a positive return was commodities and gold. The S&P 500 was down over 18%. Treasury bonds, the supposed safe haven, were down over 15%. Bitcoin was down over 64%. In a year where almost everything lost money, gold was roughly flat to slightly negative. In relative terms, that is a win. Silver rose alongside gold in the initial Ukraine invasion panic, reaching about $27 in the spring of 2022. Then it sold off with the broader risk assets as rate hike fears dominated. Silver ended the year down meaningfully. The key distinction: silver has a significant industrial demand component, and fears of a global recession in 2022 weighed on industrial metals. This is the double-edged nature of silver. It is both a monetary metal and an industrial input, and sometimes those two forces work against each other. Treasury bonds. This is the one that should have every American with a 401k asking very serious questions. In 2022, stocks and bonds fell simultaneously. That had not happened in any meaningful way for decades. The entire modern portfolio management industry is built on the assumption that bonds go up when stocks go down. In 2022, they did not. Long-duration Treasury bonds lost 15, 20, or even 30% of their value depending on the duration. Millions of Americans who were told their bond allocation would protect them watched both halves of their portfolio decline at the same time. The 60-40 portfolio, 60% stocks, 40% bonds, had its worst year since at least the 1930s. U.S. dollar. The dollar had its best year in 2022, with the dollar index surging about 15%. Strong dollar policy and aggressive Fed rate hikes made dollar-denominated assets relatively attractive. If you were holding cash in 2022, you felt okay. but inflation was still running above 8%, meaning you were losing purchasing power in real terms, even as your nominal dollar balance looked stable. Bitcoin fell 64.3% in 2022. The entire crypto complex collapsed. FTX collapsed in November 2022. The digital gold narrative looked very shaky. Crisis 4 scorecard. Gold, relative winner in a bad year for everything. Silver, sold off with industrial commodities. Treasuries, shocking failure. The biggest wake-up call for buy-and-hold bond investors in a generation. Dollar, short-term winner in nominal terms, long-term loser in real terms. Bitcoin, devastating losses, credibility badly damaged. Crisis 5, the current crisis, 2024 to now. I want to be precise with you here, because this crisis is still unfolding, and I will clearly separate what I know from confirmed data versus analytical interpretation. What I know as a confirmed fact: gold surpassed $5,000 per ounce for the first time in human history in early 2026, before pulling back sharply. As of March 22, 2026, gold is trading at approximately $4,623 per ounce. According to the World Gold Council, gold set 53 new all-time highs during 2025 alone, with an average fourth-quarter price of $4,135, a 55% year-over-year gain, the strongest annual performance since the 1970s. What I know is a confirmed fact: central banks purchased 863 metric tons of gold in 2025, nearly double the pre-2022 historical average of 473 metric tons per year. This is not speculative retail behavior. This is the world's governments and central banks, the same institutions that manage the dollar system, systematically shifting their reserves into gold. According to the World Gold Council survey, 95% of central banks expect global official gold reserves to increase over the next 12 months. A record 43% said they personally plan to increase their own holdings. When the people who run the monetary system are moving away from their own paper currencies and into gold, that is not noise, that is a signal. Silver's story in the current crisis has been nothing short of extraordinary, and I have to be honest with you, it has moved so far since this video was originally scripted that we had to reshoot this segment entirely. Silver opened 2025 at $30 per ounce. By January 29, 2026, it had reached a new all-time nominal high of $121.67. Full year 2025, silver gained approximately 148%, the best performing major asset of the year by a wide margin. As of March 22, 2026, silver has pulled back sharply and is trading at approximately $71.62 per ounce. The paper market volatility is real, and it is brutal, but the structural supply deficit, now entering its 6th consecutive year according to the Silver Institute, has not changed. Silver now has a demand story that gold does not have. Solar panels, electric vehicles, semiconductor manufacturing. Silver is a non-negotiable industrial input in every major clean energy build-out happening right now. The U.S. government added silver to its critical minerals list in 2025. This is my analytical interpretation, not a sourced fact. The structural case for silver remains intact even after the correction from the January highs. Long-duration Treasury bonds remain deeply underwater from their 2020 peak. The iShares 20-plus-year Treasury bond ETF is still down over 50% from those highs. If you held long bonds as your safe haven for the last several years, you have had a devastating experience. The credibility of bonds as a safe haven has been seriously damaged by a world of persistent deficits and a Federal Reserve that has demonstrated it will monetize that debt when necessary. The U.S. dollar index has been weakening through 2025 and into 2026. A weaker dollar is a direct structural tailwind for gold and silver. When the world loses confidence in the dollar as a store of value, assets with genuine scarcity reprice upward. That is not a conspiracy theory. That is basic monetary economics playing out in real time. Bitcoin recovered strongly from its 2022 lows and reached new all-time highs in 2024 and early 2025. I will give it full credit for that performance. But the correlation data has not changed its classification. Bitcoin continues to move more like a leveraged technology stock than a monetary safe haven. When panic hits, and I showed you the March 2020 data earlier in this video, it amplifies losses rather than cushions them. Bitcoin may yet mature into a genuine store of value. Right now, the crisis behavior data says it is not there yet. Crisis 5 scorecard. Gold, historically dominant, up 125% in under 2 years, even after the current pullback, with central banks buying at double historical rates. Silver, the most volatile and the most spectacular, up 148% in 2025 with a structural supply deficit that is not going away. Treasuries, still recovering from a generational beating. Dollar, weakening trend that directly fuels the case for hard assets. Bitcoin, impressive recovery, real institutional adoption, but crisis behavior still says risk asset, not safe haven. The final verdict. All right, 5 crises, 5 assets. Here's what the scoreboard says. Gold won 4 out of 5 crisis evaluations on a full window basis. In 2008, in 2011, in the post-COVID debasement window, and in the current crisis, gold did exactly what a monetary safe haven is supposed to do. It held value through the storm and rewarded patience. The one partial failure, the acute March 2020 panic, was followed by one of gold's strongest bull runs in history. If you held physical gold through every single one of these events, you did not just preserve wealth, you grew it substantially while most other assets were struggling. Physical gold, not paper gold, not GLD, not a futures contract. The metal in your hand. Silver had a more volatile ride, bigger drawdowns, bigger recoveries, and now a structural industrial demand story that makes it fundamentally different from where it was a decade ago. Silver is not for the faint of heart, but for investors who understand the volatility and can hold through the paper market games, silver has delivered extraordinary returns in every major post-crisis recovery window. And the paper versus physical divergence, where the COMEX price gets pushed down while retail premiums spike and physical supply tightens, is one of the most important structural stories in the precious metals market right now. Treasury bonds have failed retail investors in ways that should fundamentally change how you think about portfolio construction. The 60-40 model is not a safe haven strategy. It is a product that Wall Street sells you because it is easy to manage and it generates fees. In a world of persistent inflation and structural government deficits, long-duration bonds carry risks that most financial planners are not adequately disclosing. The US dollar is a useful short-term crisis refuge, but holding cash as a long-term safe haven against dollar debasement is like trying to put out a fire with gasoline. The very instrument that creates the crisis is not the solution to the crisis. Bitcoin is a fascinating asset with real upside potential, but calling it digital gold, implying the same crisis behavior, is marketing, not analysis. The March 2020 data is definitive. When you needed it to hold, it fell faster than almost everything else. That may change, but for now, treat Bitcoin as a speculative technology bet, not a monetary safe haven. Here is what I want you to take away from this video. The next crisis is not hypothetical. It is a certainty. We do not know what it looks like when it hits or how bad it gets. What we do know, from 5 separate real-world stress tests covering banking collapse, sovereign debt crisis, pandemic panic, stagflation, and monetary system realignment, is which assets have consistently done the job they were marketed to do: gold, and with more volatility but potentially more upside, silver. The central banks that run the monetary system are buying gold right now at historically elevated rates. They are not doing that because it is trendy. They are doing that because they know something about the trajectory of their own currencies that they are not saying out loud. I'm Arthur. This is Smart Money History. If this video opened your eyes to something you were not seeing before, that is exactly why we do this. Share it with someone you know who is still being told their bond allocation will save them. And I will see you in the next one.